Hi, thanks for joining us today. We're going to talk about what's happening in terms of seeing stablecoins and the intermediation of Bitcoin be represented as we now have working money in the context of blockchain operations. And uh, we've been calling this out as being a falsehood for a long time. I know I've been doing it since at least 2016. Um, what we saw the other day was a post on LinkedIn in which the idea that you can buy a tomato in Spar in Switzerland was being celebrated, that you could buy this tomato with Bitcoin. But in actual fact, as I pointed out in the conversation, you're not buying with Bitcoin. You're buying with a representation of somebody else's ledger of Bitcoin. So actually what you're doing is the classical system where you are trading on somebody else's ledger in which they hold all of the assets that ultimately are being transacted between the parties, and you have to trust them. The whole point of blockchain is to be able to trust the message, not the messenger, securely at scale. And here we are back to seeing a state in which we must trust the messenger, not the message, in order to have security and scale. And it's questionable whether we have either, because in fact, behind that sits Binance, who provide the ledger of the Bitcoin. And you have to trust them, despite the fact that Binance don't actually have any real oversight over any of their activities. So, what we saw was a celebration of intermediation in order to pretend that Bitcoin can be used as a purchasing currency and not just as a speculative number go up open Ponzi scheme, which is what it's become. It started being this incredible proof of concept for the ability to have a non-debasable source of fun of money, the mint, that could be traded peer-to-peer between actors. In that example, if someone were actually using Bitcoin to purchase a tomato in Spar, they would be standing in the queue for somewhere between 10 minutes and several hours, unless, of course, the Spar were to trust the meme pool and trust that the guy doesn't then do a contrary trade immediately afterwards and nil out the position. The alternative we've seen is where stablecoins have emerged. And stablecoins are essentially money market funds in which the operator of the stablecoin gets to retain all of the yield from the bonds that they claim are underpinning the dollar value of what they offer. The utility provided to the blockchain user is that they can take their clown coin, and instead of having to ask the so-called exchange to take intermediary risk, that they take your clown coin or the ETH that you've converted your clown coin into and turn that into dollars that you can go and buy your Lambo with. Instead, we have this stable coin that creates the illusion that you are taking clown coins and turning them into dollars via this tool. And this also becomes posed as being, well, this is how we can do transactions on chain. But again, we're having to trust the issuer. The whole point about a blockchain, the whole point about Bitcoin, and the whole point about the Gajimara that we've built is that we do not believe that anybody can be entrusted to build or to run the mint. The mint is inherently something that cannot be corrupted if we are to stop debasing human capital, which is what we do when we print money. Inflation is the printing of money. The idea is that we can get to a point where we no longer have the debasement of human capital through the printing of money, and we no longer have the taxation of intermediation and rent seeking upon that, largely done in a way that privatizes their profit and socializes their risk. And with stablecoins, that's exactly what we're going to see. The privatization of egregious profit, because they no longer even have to share the yield with anybody. And when the wheels come off, and it turns out that actually they weren't telling the truth about what their reserves are held in, and there is contagion in the system, we're going to see the socialization of that risk, which will lead to yet more money printing and yet more debasement of human capital. So with that, introducing our youngest team member and representative of the generation that can never hope to have anything thanks to monetary debasement,
Ouch.
we have Jarvis Towell.
Dang.
This is going to be a really positive conversation, as you can tell. But batting that off to the team, I mean, this is what we're seeing. We're seeing a whole industry try to create the pretense that something works that doesn't. And as Jarvis and Craig talked about in the longer form video very well, this is all driven by a race to the bottom, a breaking down of trust within the system that everybody now, nobody believes that the system is trustworthy anymore. So there's a race to see who can get to the bottom and profit first. But Ulf, over to you. This whole idea that somebody is trading or buying tomatoes in Bitcoin, the reality.
Yeah, so, well, like you said, the Binance is one of the centralized exchanges that basically came about because trading on blockchains was not feasible, and essentially every blockchain devolved into the price of the coin being the only business case that actually worked. And so with the centralized exchanges, you can bet on all the different coins at once, and they go up and down. And essentially, the activity is just in the database of the exchange. It
Right.
doesn't
So
really
as
touch the
long as we
blockchain.
trust them, we can trust that
Yes.
everything's going to be okay, and that the capturing of number go up on my clown coin in terms of US dollars can be trusted, and therefore there's validity in me playing in this casino. Correct? Uh,
Yes.
Great.
And stable coins became an answer to a need there. If all the coin prices are fluctuating, you'd like to have one currency that you can actually rest in, where and so then some actor comes in and says, we're going to peg this currency to the dollar, and you can
To
trust
the
it.
fiat, to the fiat you guys were trying to escape in the first place. But never mind that.
Well,
And
but
compared to
hold
all
on.
the other
Ulf is
currencies,
right.
it was stable enough.
There was a legitimate need here, because what
Hmm.
the exchanges were doing was saying, okay, well, we'll take your clown coin and we'll allow you to convert it to ETH, and we will take the risk that ETH keeps going up in price.
Hmm.
But what if it doesn't? And what they wanted to get to was a situation where they could be a rent-seeking intermediary who privatized profit and then socialize the risk. And that is where stable coins came in. That's what they gave them the capacity to do. So Ulf is quite right that the demand for stable coins came about from exchanges saying, well, I don't really want to continually hold this ETH with nobody else to hand this off to in the event that the market should fall.
Hmm.
So if Bitcoin had actually delivered on the initial promise that it would be a peer-to-peer exchange where you could actually conduct trade on the blockchain, where I could buy something from you, in that case, actually on a free market with a functional currency, the parties involved in a trade are all interested in the currency being stable, because everything else actually introduces risk to both parties. So
Hmm.
with a blockchain coin that actually works as proper money, the value of that coin should be determined by the volume of actual useful transactions being done on the blockchain, which eliminates the need for a stable coin, really.
Yeah, I
Hmm.
mean, the whole idea that we need a stable coin, which is essentially a money market fund in which you, the buyer of the stable coin, give up upon any claim upon the yield and allow the stable coin issuer to pocket all of that for their own devices. If only money market funds could have thought this up before, I'm sure they'd have been delighted. But unfortunately, they had to work within regulated auspices, and they had to work with investors who would laugh at the idea that they should give you their money and then allow you to make all of the profit on it. Craig, Jarvis, you guys talked about low faith society, the rush to the bottom, but Craig, you spoke very well on what it is that Bitcoin really did. What was the real innovation, and what it is that we're really getting away from with all of these so-called innovations and the Gartner hype cycle.
Right. So the big innovation of Bitcoin was that instead of having uh, money be bound purely as a reference to something physical, gold or whatever, and then that gets taken over by a legislated minting right, and then the minting right itself becomes the fiat basis for the value. And so whatever's printed on the silver or the gold is what you have to accept it as, even after the mint starts debasing the gold. And now it's only 10% gold, but you have to accept it as if it's full price. And if you don't, that's a capital crime and the king kills you. Um, that referential value problem, in addition to in the longer conversation, we get into a lot of the details about this, which were interesting. But um, the basic innovation of Bitcoin, the fundamental part, is that Bitcoin is a self-referential version of money. So you don't have an external reference that you're pointing to. Bitcoin just points to itself. And in our case, any proof of work minted coin points to itself. So that's why the Gajimoto that's one of the reasons the Gajimoto has to be a proof of work system, is because there's no issuer. And that means that the money has a special property of being referential to itself. It doesn't depend on some external value. So when we agree to use that as a system of currency, it's conferred value by common utility. And the utility part, that, as Ulf pointed out, that's kind of what failed with Bitcoin. Was the technology worked like to some degree to prove the point, but it didn't actually work in practice because it's not all the reasons that crypto is hard to use in practice, scalability and so on. The Gajimoto solving those technical issues allows us to have this great innovation, which is self-referential money in a context that actually works in a peer-to-peer way, finally.
So when we looked at the hype cycle, we talked about, and you gave it a good example of Palm Pilot became today's iPhone, Android phone, eventually. And the trough of disillusionment was pretty real there. You know, you saw a lot of these devices cease being used and become dust collectors in somebody's closet. And they were very expensive at the time, but they pointed to what this could become. And it led to the iPhone. What we've seen with Bitcoin and with cryptocurrency as a concept and idea is we entered this trough of disillusionment where it was realized that actually it cannot be what it says it wants to be, which is a peer-to-peer electronic cash system, because it simply doesn't have the scalability to work. Now, the guys who wrote the Bitcoin NG paper were still pushing at the idea that it can be made to work. We can innovate. But actually, all of the incentive, and this goes back to why we cannot trust the mint. We must have a trustless mint. Money cannot be trusted to anybody, because all of the incentive at the time and all of the money to be able to push the agenda was in, well, hey, Bitcoin went from 100,000th of a cent to $3,000. We can make it go to 10,000 if we tell everybody that this is the future of money and it's a store of value. So the store of value narrative was then created, and it all became about number go up, and it became this massive open Ponzi scheme. But fundamentally, we're still, as cryptocurrency, at the very nadir of the trough of disillusionment, because other than us, nobody took Bitcoin and said, that is phenomenal. Others have done different things where they've created proof of stake coins, which essentially is like Dorothy putting on her ruby heels and clicking her heels together 3 times and saying, I want to be rich, I want to be rich, I want to be rich. But that transformative step hasn't happened because the incentive structures haven't been there from their perspective. The easy money was in, I've got a lot of Bitcoin, let's make the price go up. And let's get other people to get on board with this and get them to become mouthpieces for this noise about number go up, number go up, number go up. FOMO, greater fool comes in and adds to the pile. Ultimately, you can't buy something with it. You can't do things with it. It isn't a currency of reference. And just to finish this point, Ulf, you made a good point off recording about how in the end, when you have a proper self-referential currency base, the incentives change.
Yes, because you want the exchange token of exchange to have a stable value, and so that you can actually cash out on the level that you agreed on, and which is what we are aiming for. We are trying to solve the practical issues that stood in the way of other blockchains being actually usable in practice as money.
Yep. So, folks, with that, we'd love to hear what your own examples of what sort of things you've seen where someone said, hey, you can now do X using Bitcoin. Of course, it's intermediated. Why do you trust it? Why do you think this is real? Is it that you weren't aware that these things are being intermediated, or is it you didn't care? Comments in the box. Thank you. Bye-bye.